Imagine you are a company, right? And you are importing millions of Indian rupees worth of raw material.
Okay, setting the scene.
Yeah, and you just pull all these materials right into your warehouse.
Uh-huh.
But here's the crazy part. You completely bypass the customs desk without paying a single rupee in import duty.
Oh, wow. Just a complete 100% waiver at the port.
Exactly, a total waiver. I mean, for a brief moment there, the CFO is basically a hero, right?
Oh, absolutely. The cash flow forecast probably looks pristine.
The boardroom is thrilled. Everyone is high-fiving. But there is this massive invisible string attached to that waiver.
There's always a string, isn't there?
Always. The government mandate here is incredibly clear. You have to manufacture goods using those specific materials, and you must successfully export them within exactly 6 years.
Okay, so there is a ticking clock.
A huge ticking clock. If you miss that deadline or, if your export orders just dry up entirely.
Which happens all the time in the real world.
Right. If that happens, that waiver just vanishes. Poof.
Aye.
And you suddenly owe every single Indian rupee of that duty back to the government.
That is a terrifying prospect.
It really is.
Aye.
So you have this massive financial benefit just sitting in your warehouse, but it is tethered to a 6-year timer.
Yeah.
So the question for you today is, how do you possibly present that reality on a balance sheet?
Yeah.
Without misleading your investors or terrifying your auditors or just totally violating the core principles of financial reporting.
Well, I mean, that scenario right there, it strikes at the very heart of why accounting standards even exist.
Really? How so?
Because it forces this complete separation between physical reality, like actually having the materials and keeping your cash, and the economic reality.
Right, which is much more complicated.
Exactly. The economic reality is fraught with all this conditionality and multi-year risk.
Which is exactly what we are getting into today. Welcome, everyone, to a brand new deep dive on the JAP Advisors Ind AS Clinic podcast.
Glad to be here.
We are going to spend this entire session just unraveling that exact scenario. We're looking at, the really intricate architecture of government incentives.
Conditional liabilities, too.
Yes, and the profound differences between an asset and an income stream, because it gets confusing.
It really does get confusing. And for the listeners, we are sourcing this specific, highly complex reality from the foundational issue repository on gapadvisors.com.
Oh, man, that repository. If you are operating in the finance or audit space and you haven't explored this yet, you are missing out.
It really is an essential database. I mean, it hosts over 4,500 real-world issues and their detailed responses.
And that covers both Ind AS and Indian GAAP.
That's right, both of them.
The sheer volume of case studies they have there is just staggering. But you know what makes it a really critical tool?
The accessibility.
Exactly, the accessibility. Because literally anyone can register for free.
Yep.
You just go on, submit highly specific issues on Ind AS or Indian GAAP, and you receive a detailed, rigorously researched response delivered directly to your email inbox.
It is amazing, and it fundamentally changes the workflow, particularly for auditors.
How so? Like in a day-to-day sense?
Well, when you are an auditor and you are signing off on financial statements, you absolutely cannot rely on a company's internal optimism.
Right. You can't just take their word for it that everything is going to be fine.
Exactly. You need ironclad documentation on exactly how and why a specific issue regarding the application of Ind AS was addressed.
Ah, so you need the backup.
You need the structural logic to defend those audit decisions.
Right.
And that's exactly what the repository provides.
Which actually brings us to the specific origin of today's deep dive. This case study we are looking at, it was actually featured in the 225th edition of the GAAP Advisors Task Weekly newsletter.
That is a great newsletter.
It really is. It's authored by C.A. Manish C. Iyer, the director of GAAP Advisors, and it gets published on LinkedIn.
I think they have published over 230 editions to date, haven't they?
They have. It is just this massive public archive of technical accounting knowledge. It's fantastic.
But before we completely dissect the mechanics of this import duty waiver, we probably need to establish some baseline parameters.
Yes, and share a very vital disclaimer. We always have to do the disclaimer.
We do. So just to be clear for everyone listening, the views expressed herein are the personal views of the author and are not binding on the audience.
Right.
The audience is requested to seek the help of an expert before any action or refraining from any action based on the views discussed herein.
Always consult your own experts, folks.
Exactly. And furthermore, for the entirety of our analysis today, We are operating strictly within the Indian corporate framework.
So that means our functional and presentation currency is the Indian rupee.
Yes, the Indian rupee.
Mm-hmm.
And we are working strictly within the standard reporting period, which begins on the 1st of April and ends on the 31st of March.
Okay, perfect. So April to March, everything in Indian rupees. Let us get right into the mechanics of this thing.
Let's do it.
Okay, so the company imports these raw materials. The government waives the import duty entirely. But it's conditional upon a commensurate export obligation, and that has to be fulfilled within 6 years.
Right, the ticking clock.
So the company looks at its current export orders, they review their historical performance, and they project this immense confidence.
Naturally.
Right, they're like, oh, we will easily meet this obligation long before the 6-year deadline.
But as we know, confidence is an emotion.
It is not an accounting entry.
Exactly, it's not a journal entry.
So the very initial hurdle we have to clear here for you listening at home is defining what this saving actually is.
That's the crux of it.
Because my initial instinct, just looking at this purely from a cash flow perspective, is that nothing actually happened.
What do you mean?
Well, the government didn't deposit Indian rupees into the company's operating account. A transaction was simply avoided, So classifying a non-payment as a government grant feels like a huge stretch of the definition to me.
I totally understand the instinct to view it that way. We're all heavily conditioned to view a grant as an act of transfer.
Right, like a literal check being written.
Yeah, or a wire transfer being completed.
Yeah.
Money hitting the bank.
Exactly. But in AS 20, which is the standard governing grant, accounting for government grants and disclosure of government assistance, it requires us to look way past the physical movement of currency.
Okay, so what are we looking at instead?
We have to evaluate the true economic substance of what just occurred.
Economic substance. Okay, I'm with you.
If you look at paragraph 3 of the standard, it defines government grants very specifically.
Let me guess, it's a dense definition.
A bit. It defines them as assistance by the government in the form of transfers of resources to an entity.
Okay.
And that transfer is in return for past or future compliance with certain conditions relating to the operating activities of the entity. See, I have actually been studying that specific phrasing in paragraph 3.
The transfers of resources part.
Yes, because if a company simply retains its own Indian rupees because a tax just wasn't levied on them, the resource never actually left their account in the first place.
I see where you're going.
Right. There is no external transfer inward. It honestly feels like defining a shadow as a light source. It's the absence of a transaction.
That's a great analogy, but you have to think about the mechanics of the liability itself.
Okay, walk me through that.
Under normal circumstances, the exact moment those imported goods arrive at the port, a legal obligation is born.
Right, the customs duty.
Yes. The company instantly owes the government a highly specific quantum of Indian rupees.
Okay.
That liability exists entirely independent of the actual payment.
Oh, I see. It's there whether you've written the check yet or not.
Exactly. So what the government is actually doing here is extinguishing a statutory liability.
They are wiping the slate clean on a debt you technically already owed.
Yes. Economically speaking, the government waiving a mandatory, say, 50 million Indian rupee import duty is mathematically and functionally identical to something else.
Identical to what?
To the government actually collecting that 50 million Indian rupees from you, placing it in the treasury, and then immediately issuing a 50 million Indian rupee grant check right back to your company.
Oh, wow. To incentivize the export manufacturing.
Precisely.
So the standard setter is essentially just cutting out the middleman.
That's a great way to put it.
They are acknowledging that forcing this massive cash outflow just to process a subsequent cash inflow is administratively inefficient.
It would be a nightmare for everyone involved.
So the resource being transferred is actually the relief from that outgoing cash flow.
Exactly. The preservation of your existing capital through this targeted waiver of a statutory liability that is a very real transfer of economic value.
Because at the end of the day, you are richer on a net asset basis.
Right. You are richer compared to the baseline scenario of standard commercial operations where you would have had to pay that duty.
Okay, that makes a lot of sense. The economic reality versus the physical cash movement.
But the standard also establishes some very critical boundaries here.
Like what?
Well, if you look at the second half of that definition in paragraph 3, it actually excludes certain things.
What gets excluded?
It excludes government assistance that cannot reasonably have a value placed upon it.
Okay.
And it also excludes transactions with the government that cannot be distinguished from normal trading transactions.
Ah, okay. That exclusion seems really vital.
It is. Why do you think that is?
Well, to prevent companies from just inflating their balance sheets with nebulous government benefits, right?
Spot on.
Like, for example, if the government enacts this broad macroeconomic policy, say they lower the national corporate tax rate for everyone.
Right.
Or maybe they build a massive dedicated freight corridor right next to a manufacturing hub.
Which is a huge benefit to any factory there.
Exactly. That clearly assists the entity. It helps them operate cheaper and faster. But you cannot isolate the specific financial value of that policy to a single company's ledger.
That is the exact distinction. A new highway improves logistics for everyone, but it is general infrastructure.
It's too broad.
Right. It lacks specific, measurable conditionality attached to a single entity.
But in our scenario with the listener today,
In our scenario, the import duty saved is an exact, mathematically precise figure in Indian rupees.
50 million or whatever the exact invoice says.
Exactly. It is tied to a highly specific, identifiable transaction.
The import of those specific raw materials.
Yes. And it carries a highly specific condition.
The 6-year export mandate.
Right. Therefore, because of all those specific factors, it unequivocally meets the stringent criteria of a government grant under Ind AS 20.
Okay, I'm sold. We officially have a grant to account for, but, identifying the entity as a government grant is only the prologue here.
We are just getting started.
Because the standard requires categorization next. And honestly, this is where I see immense potential for financial manipulation if things aren't strictly audited.
The categorization is crucial.
We basically have two primary buckets to sort this into, right? Grants related to assets and grants related to income.
That's right. And the standard setter approached this categorization with a very strict, almost binary logic.
Oh, so?
Well, paragraph 3 explicitly defines grants related to assets.
What's the definition?
It says they are government grants, whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets.
Okay, so it has to be a long-term asset.
Yes. It also allows for subsidiary conditions, like perhaps restricting the geographical location of the asset.
Like saying you must build this in this specific rural zone.
Exactly. Or it might mandate a specific holding period, like you have to keep the equipment for 10 years.
So we are really talking about heavy capital expenditure here. Like the government gives you a massive grant to build a semiconductor fabrication plant.
Or maybe to acquire a whole fleet of specialized mining equipment.
Right. Assets that are going to be capitalized and then depreciated over a decade or more.
Exactly. That is your asset grant bucket. And then the standard defines grants related to income using this process of absolute elimination.
Elimination, like a catch-all.
Yes. It simply states that grants related to income are all government grants other than those related to assets.
So if it does not fund a long-term asset, it just defaults to the income category automatically.
It's a very elegant binary rule.
So let's apply that to our case study. The facts we have state that the company imported certain raw materials.
Right, raw materials.
By their very nature, raw materials are basically the antithesis of a long-term asset.
Completely.
They are imported, processed, consumed, and then sold. And usually all of that happens within a single 12-month reporting cycle.
Yes, typically between April 1st and March 31st of the same financial year.
Right. They are the very definition of operating inventory.
Which means?
Which means it is mathematically and logically impossible to classify this specific duty waiver as a grant related to assets.
Yeah.
It has to fall squarely into the income bucket.
Nailed it.
But, let's explore the friction here for a second, because why does this binary distinction actually matter so deeply?
It matters a lot.
But why? Like, to an auditor or investor who is just analyzing the financials, let's say we have a highly aggressive management team.
Uh-oh. The road CEO.
Right. And they attempt to creatively classify this raw material duty waiver as an asset grant.
How would they even argue that?
Maybe they argue that the resulting export goods are building long-term brand equity in a foreign market, so it's a long-term asset.
That's a stretch, but let's play it out.
If they do that, what is the actual damage to the financial statements?
The damage would be a catastrophic distortion of the company's operating metrics.
Really? Catastrophic?
Absolutely.
Yep.
To understand why, you have to look at how asset grants are actually recognized on the books.
Okay, break that down for me.
When you receive a grant related to a long-term asset, Ind AS 20 generally allows you to present it by deducting the grant in calculating the carrying amount of the asset.
Wait, run that by me one more time.
Okay, so you buy a machine for 100 million Indian rupees, and the government gives you a 20 million rupee grant for it.
Okay.
You can deduct that 20 million, so on your books, the asset is only valued at 80 million.
Ah,
And this effectively reduces the depreciation expense recognized in the profit or loss statement over the useful life of that asset.
So if you receive a grant for a factory, your annual depreciation expense is artificially lower,
Yes.
which slowly, year by year, boosts your reported profit over a 10 or 20-year period.
Exactly. It spreads the benefit out over a very long time. But raw materials are not depreciated.
Right. They aren't around long enough.
They flow directly into the cost of goods, sold the exact moment the finished product is sold.
Ah,
So if a management team artificially stripped this massive duty waiver out of the current operating cycle,
and attempted to amortize it over a long-term horizon as if it were an asset grant.
they would be fundamentally misrepresenting their current year gross margin.
Oh, I see it now. Because the cost of those raw materials is hitting today, but the benefit is being pushed out into the future.
Or vice versa. Either way, it's a mismatch. An investor reading the income statement for that April 1st to March 31st reporting period.
They expect the cost of goods sold to accurately reflect the true economic cost of the materials consumed to generate that specific year's revenue.
Exactly. By hiding the waiver and a long-term asset classification, the company would be smoothing out their earnings artificially.
Making their core manufacturing operations look drastically different from reality.
It totally destroys the comparability of their financial statements.
Because if you compare them against a competitor who is correctly applying Ind AS, it looks like they have totally different margin profiles.
Precisely. Which is exactly why the rigid binary definition in paragraph 3 exists.
It removes management's discretion entirely.
It does. Raw materials are not long-term assets. Therefore, this is an income grant. End of story.
The logic is impenetrable.
And that gives the auditor the necessary ammunition to enforce the correct accounting treatment when management tries to get creative.
I love that. It protects the auditor. So this brings us to the actual operational reality of day one.
Fun part, journal entries.
Right. So picture this. The ship arrives at the port on, let's say, the 10th of May.
Okay, May 10th.
The raw materials are unloaded, the customs clearance is officially stamped with a zero-duty waiver, and the goods are physically transported to the company's warehouse. Mechanically, on May 10th, how is this hitting the accounting books?
Well, at initial recognition, the company obviously must bring the inventory onto its balance sheet.
Right, they have the physical goods.
So there is going to be a debit to the inventory account.
Okay, debit inventory.
And that captures the full value of the raw materials, inclusive of the duty that would normally have been paid to bring the asset to its present location and condition.
Wait, inclusive of the duty, even though they didn't pay it?
Yes, because that is the true economic value of the inventory sitting in the warehouse.
Okay. But because that duty portion wasn't actually settled in cash, we didn't write a check for it. We need a corresponding credit somewhere to balance the books.
Exactly. Every debit needs a credit. And this is where the core philosophy of financial reporting really takes center stage.
Because I can imagine a confident CEO stepping in right here.
Oh, absolutely.
The CEO would argue, look, we have the inventory, we didn't pay the duty, and we have a massive order book guaranteeing we will meet this export condition.
So let's book the win.
Right. We should credit our profit and loss account immediately. We just generated a massive margin expansion on day one. Let's show the shareholders.
And that CEO would be running headfirst into a brick wall.
The brick wall of accounting standards?
Specifically, the foundational principles of prudence and the matching concept.
Okay, explain how those principles block the CEO here.
Well, the GAAP Advisor's repository response dictates this very clearly. The corresponding credit cannot go to immediate profit. It must go to a specific liability account.
A liability account. What is it called?
Deferred government grant.
Deferred. So creating a deferred liability account instead of recognizing immediate income, that is a really powerful philosophical statement by the standard setters.
It is. What is it saying to you?
It essentially tells the company, we do not care about your confidence.
Nope.
We don't care about your historical track record or your forward-looking projections. Until the condition is physically met, you have not earned a single rupee of this benefit.
That is exactly it. It is the ultimate safeguard against recognizing unearned windfalls.
Because the government didn't waive that import duty just to, bolster the company's balance sheet for fun.
Right. They waived it in exchange for future compliance.
The successful export of manufactured goods within that 6-year window.
Exactly. So on the 10th of May, when those materials are merely sitting quietly in a warehouse,
The company has fulfilled exactly 0% of that condition.
0%, which means they have earned 0% of the grant.
So this deferred government grant account, it basically acts as a financial escrow.
Escrow is a great word for it. It is a holding pen on the liability side of the balance sheet.
A holding pen. I really like that conceptualization.
It makes it easy to visualize.
Because if the company were permitted to recognize that waiver as immediate income, their profitability for that specific reporting period, the one ending March 31st, it would look extraordinary.
It would look like they had an absolutely blowout year.
Right. And investors might drive the stock price up based on what appears to be this massive leap in operational efficiency.
But it's a mirage.
Exactly. Because what happens in year 3 if, say, a massive geopolitical crisis suddenly shuts down their primary export market?
Oh, that's a nightmare scenario.
Right. The 6-year clock is still ticking. It doesn't care about the crisis. But they are physically unable to ship the goods.
So eventually they breach the condition.
And when they breach it, that massive duty waiver immediately reverts into a payable liability to the government.
Probably with some very severe interest penalties attached too.
Oh, undoubtedly. And if they had already claimed that grant as income in year 1.
Well, now they are in huge trouble because they would be forced to record a catastrophic unprovisioned loss in year 3 or year 4 just to reverse the original transaction.
Their financial statements would be characterized by this extreme artificial volatility.
It would be a roller coaster.
Yeah.
And it would be completely detached from their actual day-to-day manufacturing operations.
It ruins the whole point of financial reporting.
Right. By enforcing the deferred government grant liability, Ind AS 20 ensures the balance sheet reflects the true economic risk at all times.
The company holds a benefit, yes, but it is deeply conditional.
Always conditional until it's discharged.
Okay, so let us trace the life cycle of this conditional benefit.
Okay, moving forward in time.
Yeah. The raw materials, they move from the warehouse to the factory floor. They undergo processing, packaging, all of it.
Standard manufacturing cycle.
Right. And finally, finished goods are loaded onto vessels bound for international markets.
Success.
Yes. So as these physical exports occur, the company is actively discharging its obligation to the government.
Yes, they are finally doing the work.
So how does that physical movement of goods translate into unlocking the financial holding pen? Because the money has to move eventually, right?
It does, and the transition from liability to income is governed by the principle of systematic and rational matching.
Okay, rational matching. What does the journal entry actually look like?
Well, as the export obligations are discharged by the company from year to year, journal entries must be passed to recognize the economic reality that the condition is being met.
Right.
The repository response clearly outlines that the deferred government grant shall be recognized in profit or loss in the proportion of the export obligation discharged by the company in the respective year.
Oh, okay. The operative word there is definitely proportion.
Very important word.
Because it requires a highly systematic calculation at the end of every single reporting period.
Yes, every year on the 31st of March.
On March 31st, the finance team basically has to sit down and assess exactly what fraction of the total 6-year obligation has been irrevocably fulfilled.
Exactly. Let us attach some real numbers to this so you can visualize it better.
Okay, give me some numbers.
Assume the total deferred grant sitting on the liability side is 100 million Indian rupees.
Okay, 100 million INR.
And the government mandate requires the company to export a total volume of, let's say, 500,000 units of finished product over the 6-year window.
Got it. 500,000 units total.
Right. So by the time the reporting period closes on March 31st of year 1,
Okay.
the company has successfully manufactured, shipped, and recognized revenue on 50,000 units.
Okay, doing the math. 50,000 out of 500,000. So they have discharged exactly 10% of the physical obligation.
Exactly 10%.
Therefore, logically, they have earned the right to recognize 10% of the deferred financial benefit.
Correct. So what would the journal entry be on March 31st?
Well, you would have to reduce the liability, right? So you would debit the deferred government grant account by 10 million Indian rupees.
Yes. 10% of the 100 million.
Right. And then you would credit income from government grant in the statement of profit or loss by that exact same 10 million Indian rupees.
You got it perfectly.
See, this proportionate recognition, it aligns perfectly with the matching concept you mentioned earlier.
It's the matching concept in its purest form.
Because the income from the grant is flowing into the profit and loss statement in the exact same periods and in the exact same proportions as the costs associated with manufacturing and exporting those specific goods.
Right. You have the revenue, the cost, and the grant income all hitting at the same time.
Which prevents any single reporting period from bearing the full cost of production while a different period absorbs the entire benefit of the grant.
It creates a perfectly synchronized financial narrative. It tells the true story of the year.
And this process just repeats annually, right?
Every single year.
Every April 1st to March 31st cycle, the company measures the discharge, calculates the proportion, and unlocks the corresponding tranche of the deferred grant.
Just steadily working down the liability until it hits zero.
But, this mechanical precision relies heavily on the assumption that everything goes according to plan.
And it rarely does.
Right. What happens when the company hits the 6-year deadline and they have only managed to discharge, say, 80% of the mandated export volume?
Then they have a problem.
Because there is still 20% of that original waiver sitting frozen in the deferred government grant account on the balance sheet.
Right. So at the exact moment the 6-year deadline expires, the conditionality completely collapses.
The timer hits zero.
Yes. That remaining 20% is no longer deferred income.
What is it then?
It instantly transforms into a crystallized, immediate financial liability payable to the government.
Wow. So they literally have to cut a check.
The company must surrender the unearned benefit and remit the cash equivalent of that remaining import duty back to the government.
Oh, man. This is exactly why maintaining that deferred account was so critical in the first place.
Now you see it.
If they had aggressively recognized all that income early on,
like the rogue CEO wanted to.
Oh, right. They would not only face a sudden massive cash outflow to the government in year 6, but they would also take a massive hit to their current year equity because they'd have to reverse the false income.
It would be a dual blow to the financials.
This entire process, though, the initial waiver, the deferred liability, the multi-year proportionate discharge, the looming threat of clawbacks, it is an incredibly complex operational reality to manage.
It takes a very diligent finance team to track all this.
But here's a thought. If an external analyst or maybe a potential acquiring entity just looks at the face of the balance sheet, they simply see a line item labeled deferred liabilities with a large figure in Indian rupees next to it.
True, just a big number.
The face of the financial statements is inherently static, right? It cannot convey the kinetic energy of this 6-year ticking clock.
It doesn't tell the whole story.
So how does Ind AS address this huge information gap? How does an investor know what that number actually represents?
This is where the disclosure requirements become, arguably, the most critical component of the entire financial reporting framework.
The notes to accounts.
Yes. The face of the balance sheet provides the magnitude, the big number in Indian rupees. But the notes to accounts provide the context, the risk profile, and the timeline.
They give the number a personality.
Exactly. The repository response explicitly directs that to make the financial statements understandable, the company shall disclose in the notes the relationship between the satisfaction of the export obligation and the movement of the deferred government grant.
That makes sense. The notes are essentially the translation layer.
That's a perfect way to describe it.
Because without them, a massive deferred liability could be misinterpreted as anything.
It could be seen as pending litigation.
Or a massive balloon payment on some weird debt instrument.
Or even just unearned customer revenue that's waiting to be recognized.
Right. An analyst would have absolutely no way to accurately model the company's future cash flows or assess their operational risk if they didn't know it was tied to an export condition.
Exactly. So a robust disclosure note for this specific scenario would have to detail several things.
Like what? What has to be in there?
Well, it would detail the specific nature of the import duty waiver.
Okay.
The exact monetary value in Indian rupees.
Right.
The strict 6-year timeline for the export condition.
Very important.
And, crucially, the precise proportion of the obligation that remains unfulfilled as of March 31st of that reporting year.
So it literally transforms a static number into this dynamic narrative of operational dependency.
It explicitly warns the reader. It says, hey, a portion of our reported profitability is deeply intertwined with our ability to maintain export volumes.
If our export channels fail, this liability will trigger an immediate cash outflow.
Exactly. It is the ultimate exercise in financial transparency.
Which is great because it prevents management from masking a highly conditional government incentive as guaranteed organic operational strength.
It forces the company to acknowledge that until the final unit is exported in year 6, the government is essentially a silent, highly demanding partner in their manufacturing cycle.
A silent partner with a ticking clock. I love that.
It really perfectly illustrates the overarching philosophy of Ind AS 20.
That economic substance always triumphs over legal form.
Exactly. The standard is fundamentally obsessed with that idea.
Because the legal form was just a zero-duty customs clearance.
Right, a transaction that appeared to cost absolutely nothing on paper.
But the economic substance is a highly restrictive, multi-year conditional loan from the government.
Yes, and one that can only be repaid through the sweat equity of export manufacturing.
Okay, let us synthesize the entire architecture of this issue for the listeners. Just pull it all together.
Let's do a recap.
We began with a company importing raw materials and receiving a complete waiver of the associated import duty in Indian rupees.
Right.
And despite the lack of physical cash changing hands, we established that the extinguishment of this statutory liability constitutes a definitive transfer of resources.
Which classifies it squarely as a government grant under paragraph 3.
Exactly. Then we navigated the categorization mandate.
Asset versus income.
Right. And recognizing that raw materials are inherently consumed within the operating cycle and just cannot meet the strict definition of long-term assets.
We determined the waiver absolutely must be classified as a grant related to income.
Correct. From there, we explored the friction between management optimism and accounting prudence.
The rogue CEO scenario.
Yes. Rather than recognizing a massive windfall on day one, the company is forced to sequester the entire value of the waiver in a deferred government grant liability account.
It acts as an operational escrow.
Recognizing that the economic benefit has not actually been earned yet.
Right.
Finally, as the company grinds through its production cycle and ships finished goods overseas, they systematically measure the discharge proportion of their obligation at every March 31st year-end.
Moving fractional amounts from the deferred liability into actual profit and loss.
While meticulously detailing the entire high-stakes timeline in the notes to accounts.
It is a rigorous, deeply logical framework.
It really is.
And it is completely designed to protect the integrity of the financial statements from the inherent uncertainties of international trade and conditional government policy.
It truly is a masterclass in how accounting standards translate complex geopolitical and economic incentives into measurable, auditable reality.
That's why I love doing this.
But, as we reach the end of our analysis today, I actually want to pivot away from the mechanics just for a minute.
Okay, where are we going?
I want to look at the broader implications. We have spent an hour discussing the strict rules, but what is the underlying lesson here for the professionals actually deploying these standards in the real world?
That's a great question. If we step back and evaluate the entirety of this deep dive, I think the most profound takeaway is the fragility of corporate confidence.
Fragility.
Yes. Think back to early in our discussion. We noted the case facts stated the company was highly confident in fulfilling its 6-year obligation based on past experience and current orders on hand.
Right, the boardroom optimism we joked about?
Precisely. That confidence drove their initial desire to recognize the benefit immediately.
We've always hit our export targets. Why wouldn't we hit them now?
Exactly. But consider the macroeconomic environment we operate in today.
It's chaotic.
It is. We have recently witnessed global supply chains freeze entirely.
True.
We have seen major shipping canals blocked by a single ship, global pandemics completely halt manufacturing, and sudden geopolitical tariffs instantly destroy established export markets overnight.
It's so unpredictable.
So what happens if, in year 5 of this 6-year window, an external shock makes exporting physically impossible through absolutely no fault of the company?
Wow. I mean, the government's 6-year deadline doesn't just pause because the global logistics network collapses, does it?
Exactly. It doesn't. The conditionality of the grant is absolute. If the company cannot export, they breach the condition.
And suddenly, that massive deferred liability sitting quietly on the balance sheet.
A liability they thought they would just slowly work off through routine operations.
It transforms you overnight into an urgent, unprovisioned, massive cash outflow.
They must repay the entire duty in Indian rupees immediately.
And that's going to happen right when their cash flows are already decimated by the very same external shock that halted their exports in the first place.
It is a perfect storm. When you realize how quickly external uncontrollable factors can force a deferred grant to revert into a catastrophic cash liability.
It completely reframes how you view a company's internal confidence, doesn't it?
It really highlights exactly why the rigid prudence of Ind AS 20 is not just bureaucratic red tape.
No, it is an essential survival mechanism for financial reporting. That is a chilling, but I think absolutely necessary perspective for any auditor or analyst to keep at the forefront of their mind.
It changes how you look at the numbers.
A deferred liability isn't just a number waiting to become profit. It is a dormant risk waiting for a trigger.
Very well said.
It underscores why understanding the why behind the standard is so much more critical than just memorizing the journal entries.
You have to understand the philosophy.
Well, we want to thank you, our listeners, for dedicating your time to navigating the deep end of the accounting pool with us today.
It's been a great discussion.
Unpacking these complex layers of Ind AS requires patience, but, the resulting clarity is just invaluable.
It really is.
So if this deep dive has provided you with actionable insights, we kindly request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts.
Yes, please do.
We are available on Spotify, Amazon Music, and YouTube. Whichever platform you prefer to utilize for your professional development, we are there.
And leave a review if you can.
Absolutely. Furthermore, we strongly encourage you to share this deep dive among your contacts, your colleagues, and specifically your audit and finance teams.
Sharing this knowledge is so important.
It is, because the more we collectively spread this deep practical knowledge regarding the application of Indian accounting standards, the stronger and more resilient the entire financial profession becomes.
Oh dear.
Thank you so much for joining the conversation today, and we look forward to unpacking the next complex reality with you soon.